Hello folks, I'm just going to do a quick video about the wheel strategy. Now that the election is pretty much over and decided, Joe Biden won, if you didn't know. Now it's time to actually start trading again. So I didn't trade at all during the election period because I was afraid of the volatility. And of course, that because I did that, I missed up on, that historic run all the way back up to near highs. So now I'm at near highs, and so the way the wheel strategy works, and we'll just use let's use Citigroup as an example. Okay, Citigroup is a bad example. Let's use eBay. Yeah, let's use eBay. Okay, so eBay is a pretty good example of this. The way the wheel strategy works is, if you're not familiar with it, so I've been trading, just to give you back, I've been trading options for quite some time now, and there's a variety of different strategies that you can do with options using, just one leg, a naked, or multiple legs, or even six legs, or whatever you want to do in the market. But I recently just discovered the wheel strategy. I don't know why, because obviously I'm not that great sometimes, and it's very different. And then to quote, you know, Daenerys Targaryen, um, the wheel strategy actually breaks the wheel of options. The reason why is because you get assigned shares. Let's just say you do on eBay here, for next week, you do a put at 48, right, which is right there, um, and you have a stop on it, right? Let's just say 3 times or 2 times the price, right? You will always get, sometimes you'll win. Let's say eBay keeps going up, you'll win and they'll expire worthless. But just as many times, and if not many times, or the one case where it goes really badly, it's just kind of even itself out. So, net net, you'll basically be even or down after commissions, maybe a little bit up, maybe a little bit down. The wheel is different because it breaks this, like, cycle of probabilities that, eventually sum up to zero gains. So if you do 48 and it goes to 48, you get assigned the shares at 48, and then the next week or 2 weeks or whatever period you like to do, you sell the call at your strike or at the money of the current price. And we can talk about that later. And if it goes above the strike or whatever strike you decide, those shares get called away. And that is actually breaking the wheel, in the sense that it basically ignores the probabilities. And if you take a look at delta, delta is pretty much the probability that something is going to be in the money. So the 48 has a delta of 8.8. That means that it has an 8.8% chance that at expiration this will be in the money by a penny, or yeah, at the money or below. So, so that's the wheel strategy, and it, you know, what else can it's pretty simple. There's not much elaboration on it. A kind of the key is trying to figure out exactly how to play it. Obviously you can just kind of decide on any kind of whatever and just play it. And today I'll show you the way that I play it and why I think it's the better way to play it. Okay, so this is a worksheet that I made called the wheel strategy, where there's two main ways that I play it, and the first is I'm looking for. So the first is stock selection. So here, you know, there's a couple there in the 16s, but most are around like the 30s, 40s, and lower 50s. And the reason why I do that is because it kind of evenly allocates my risk in terms of the shares that the capital that I have to put up for it. The other thing is that you'll notice all of these stocks, they're all major stocks that, if I do get assigned the shares, I'm pretty comfortable holding those shares, you know, until the wheel kind of, you work its way out, right? So in this case, eBay, I'm perfectly fine of holding eBay at 48. So let's say I do 48 and it goes down to below 48 expiration. I get the shares, 100 shares, whatever number, at 48, and then immediately for next week, actually before Monday, I'll sell a call right at the close on Friday at 48 or below or wherever the at the money is at to get the maximum premium. Um, and I'll ride that. I'll keep doing that until the shares get called away, and in which case, I might have a profit or I might have a small loss. But either way, I'm doing this for many, many different companies and many, many different contracts. So, I don't expect all of them to be in the money or get assigned. Um, but, it just kind of works the way out, and overall, it's a profitable strategy in my mind. Um, so let's figure out the two criteria. So the thing is, these are all pretty big stocks. Can't tell you exactly, but I believe every single stock on this list is. Let me just make sure that I'm still recording. Yeah, every single stock in this list has a market cap of 10 billion or more. That's pretty big, right? So when you do a scanner on the stocks and you bring it up, you'll always be at the top 100 or in the S&P 500 or whatever like that. But okay. So anyway, the first thing that I use is, and I think this is important, is I look at, and you can use whatever moving average you want. The reason I use this moving average is because this is what available in my trading software, Interactive Brokers, and this is the price over the moving average. So I found that stocks that are within 2%, so either 2% up or 2% bottom, has the lowest volatility. And here is the worksheet where I show that. So this is the same, so PXEMA right here, that is the same metric as what you see here on my in my brokerage. Um, so here what I'm doing is I'm looking at a 2-week close. I generally prefer options to expire within 2 weeks. So I would do options on sometimes on Tuesday, but mainly Wednesday, Thursday, Friday into next week's Friday expiration. So about 1.5 week, 1 week kind of thing. But here I'm doing 2 weeks just because it's easy as a metric. So between -1 and 1%, you'll see that the actual average is 0%. And that's exactly what you want to have. You want it to be flat to nothing. And -2 to -2%, you get, -10%. Okay. And then if you start going below -8%, you'll find that there is a negative um was negative correlation to the close. So if the price, and let's just go to the stock here, and this line is not that line. I actually need to bring up that line, but this is like a different line. Let's just say it's the same line. If the stock is below 3%, that means that there is, based on historical data, there is a negative correlation that the stock most likely will, you know, close um, below the your strike, and or below the current price. And sometimes that's okay to do that because you then get the calls, or you get assigned shares and get the calls, which generally you make more on the call side. But you don't want to get assigned for every single stock that you wheel, right? Because that's a lot of capital investment and there's a lot of risk there. So so here if I do like -10% here, -0.1%, I know I'm gonna get assigned for a few of them, but that's a very few out of like the many companies that I'm playing or the many contracts that I have for that week, and that's exactly what you want. If I play 20 companies, I prefer to get assigned maybe two, maybe three of those companies. I don't want to get assigned 10 because that's super risky. I prefer to get two and just slowly kind of build my capital that way. So I also believe this is also a very conservative strategy. Anyway, let's keep going. So above 4%, there's a zero point 0.4 correlation, which is not bad. That because you want stocks to rise above 7.5%, then it becomes negative again. And maybe I should actually make this more granular to see what 5-6% does. But what happens in that case is that the stock has just ran up way too much. So let's take a look at an example of that. Here, let's look at Uber. Wow. Okay, so this is a perfect example of this. Definitely, it's 21.34%. So it's definitely above that 7.5%. So there should be a negative correlation at this close, which means that if I put a put here, I'm definitely most likely going to get assigned because this is going to pull back, right? This is pretty parabolic. Not saying that it will, but there's a good chance that it's going to pull back. Um, and you really don't want that, right? Because you rather have it down here, get signed down here, than up here. Well, obviously you'll never get back down here, but you rather get signed like right there than get like signed like right there, which is what a reasonable premium is going to be. Um, so that's kind of the thought about that. And the other thing is here, I could definitely do something, 3 to 4, maybe it's -2 to 5% or something I could do. I could definitely take a look at that a little bit more because there's probably opportunity there. But the other problem with that is the second thing is the variance. So this is the second week high variance and low variance during that period. As you can see from -2 to 1 and 1 to 1, the variance is very uniform. It's about 5% to the top side and -5% to the downside. And this is an average. This includes craziness that happens in the market or into some of these stocks. So, your variance could actually be quite lower than that. But I'll take a look at -3%. The variance doubles. So that's that's pretty bad. Above 4%, yeah, it's still not that bad, but it's a 50% increase right there in the variance. And above 7.5%, that's almost a 100% increase. So that's why I like to keep it within -2 and 2%. Okay, so that's that. The other thing is diversification. Um, here this is recent. I included the sectors. So I want to diversify myself across the major sectors: utilities, technologies, industrial. Okay, there's only one industrial there, but no, there's not many you can choose from. Financials, energy, consumer, non-cyclical and cyclical, communications, and basic materials. I would say basic materials and industrials are pretty much the same thing. So you can kind of group those two together. Um, but you want to diversify because you just don't know what the variance is going to be. Let's take an example here. And on the most recent 2 week data that we have, you know, a diverse here, this is all the sectors across the top, and then this is the week, so 2 weeks ahead. For on this week, so if you were heavily into technology, you're gonna get creamed. You're gonna get your ass kicked because it's -8.6%. But if you diversify it across of all of that as much as you can, I know it's difficult to do, then your, is this -0.7%. and that's not too bad, right? There you probably get assigned your techs, right? In that case, you might be assigned some energy, maybe some non-cyclicals, but your rest you should be fine, and then you'll just wheel these other two segments until the rotation happens such that it kind of pops back up, and then you're good. So that's where diversification really matters. And here is the maximum or the min delta. So if you diversified, you will have min delta here of negative. It's not very important. So just diversify. So that's what I'm gonna do. Diversify. And the red here is the height of the pandemic, which is a black swan event. I can go over this a little bit later, but I don't really consider black swan events, like anything you should really consider because they happen. When they happen, you're gonna lose money no matter what, unless you're an oracle and you know that's gonna happen. You know, you're just gonna lose money. There's no doubt about it. Hopefully you have, uh, you know, you're just gonna lose money in that, and hopefully all the other money that you make on the other times kind of makes up for it, or eventually you just get back to, making money with wheel strategy. Where you keep selling cover calls, eventually it'll go back up, and you'll make your money back or most of your money back, hopefully. Um, Losses happen. There's no way around it. This is not a foolproof strategy. I seriously believe this strategy does break the wheel. But obviously that's up to you. That's up to you how you trade it. And again, the two ways I trade it is between um, -2 and 2%. Okay, maybe I'll include 3% now or 4% now, and diversification. The other thing I do is when I get assigned shares, and this is a little bit different from what other people do, is what I would do is I would, it's called a risk reversal play. Basically, what I do is I sell, let's just say, no, I'm doing for this week, got assigned last week, so I would sell the 45 at the money call, right? And then I would buy like maybe the 40 or maybe the 42 or the 42 and a half, depending on kind of what I want to do. And I will kind of protect my downside a little bit. And the other thing it does is also reduces your capital requirements because your risk is limited because if you do 45 to 400 per contract, you're only risking $500. But if you didn't have that protective put, you're risking $4,500 per contract. So it reduces your risk profile, and it also allows you to do more puts, do more wheels plays. So yeah, so that's the that's kind of what I do. It's highly profitable. It's slow, but it's profitable. The So now that the election, we'll talk about the elections a little bit. So now that the election is over, and today is Sunday, so I don't know how the future's opening yet. It's only still, just don't disregard that. It's still 9 a.m. at the moment. So I don't know how the market's going to react to Biden, because I'm definitely sure um, that the market was pricing in a Biden victory. I mean, come on. Like, I know everyone's at different ends of the political spectrum. You can't do worse than Trump has done. Um, so anyway, and the fact here is that it's at pretty much the highs of before. It could kind of I think there's two scenarios that can happen. I think it can consolidate here at 350 and then break out again, or it can just kind of dip back down and we'll be back in this kind of cycle. Um, I think it's a 50%. 50%. I don't think the market is going to rally into next week because I think the market priced in a Biden victory. So now it's kind of exasperated, after this historical 1 week run here, of like what almost 6% there. Um, I think the market's gonna be exasperated. I think it's gonna consolidate around here, maybe pull back just a little bit, consolidate, real tight consolidation, and break out again. Or it could just do this loop-de-loop thing, or this like wavy thing. That being said, because of those two scenarios, the latter being not so great for the wheel, um, next week I'm just gonna go. I'm gonna not even trade. I'm gonna do like 10%, just a couple feelers for that week, and then I'll start Wednesday for next week. But the starting for next week will probably be at like 50% allocation, or maybe even less, like 30, 50, yeah, 50% allocation, and then after that I'll do 100% allocation. But yeah, going to next week's expiration, I still feel there's probably a good premium left. Um, let's see, something like, well, that's not good because, so this purple line is the 200 SMA. It's a pretty important line. If you have any, you don't believe in technicals or anything like that, this is probably the only thing that you should put on there. So here, COP is obviously a gas energy stock. It's way below 200, so there's no way I'm gonna play that unless the premiums are like super juicy. So here, let's say 27, like here, 10% maybe. Maybe it's worthwhile. But I also need to check to see if there's earnings on this, because earnings is still it's just still earnings season. So also the other thing is I don't play earnings. It's gambling to me. Um, Even though obviously the options incorporate some of that volatility, but even that is gambling because the volatility is, you're gambling on the volatility, that the market has matched the volatility of the earnings, and you're also gambling on the earnings if the earnings are good or bad. So I don't think that's a really good idea to do that. And there's always other. I mean, there's like probably 50 stocks here, not 50 stocks, maybe like 30 stocks here. There's other opportunities out there, right? Like AIG, for example. Um, of course, obviously here the premium is pretty damn low. Um, but anyway, so yeah, so that's my plan going into next week. Probably like 20% allocation for this week just to get my feet wet a little bit, and then 50% for next week, depending on where the market's at on Wednesday. And then, if it's in a good place, then I might go a little higher. If it's still in a bad place as it is now, I'll stick at 50, and then so forth. So these are little things that you do. You're not greedy. You're not going 100% when like the market's at the very highs. That's kind of aggressive, I think. But anyway, I hope this helps people understand the wheel strategy a little bit more. You have any questions or comments or anything like that, feel free to leave it below. I'll try to answer them. I'm not an expert in the wheel strategy, but I think one thing I do that other people don't do with the wheel strategy is I actually do backtest stuff. And, I think these results here on backtesting, obviously backtesting is not 100% guarantee of future success or whatever, but I'm fairly confident. I like these numbers. It makes me more confident in my trades. Um, Obviously diversification has always is proven. There's no doubt about it. It's not like it's a unproven strategy. Diversification always helps. Obviously, you don't put your all. There's multiple things about it. You don't put all your eggs in one basket. But the way I diversify is even crazier because I do extreme diversification across the different sectors and whatnot. So it's like kind of like a weekly wheel portfolio, diversified portfolio. But anyway, talk to you guys later and good luck trading.